Thank you very much, Carl. This stage is a bit too high for me, so I don't, if you don't mind, thank you very much, Carl, and welcome to the inaugural event. Firstly, I would like to thank my team for putting this event together. At the very least, we know that if investment management doesn't work out, we might pivot into investment planning. To be honest, when I applied for the Zrosk Equity Fund, the thinking at the time, this was in May 2023, was that at the time we received approval for the fund, we were going to, the market would be in such a bull run that marketing the fund would have been very straightforward. We were very wrong in that. And I think there's a lesson there that when it comes to emerging markets and frontier markets, you can never be too confident around your forecast. Things do get worse than even your worst case scenarios. This is a milestone event for Zrosk Investment Management because this is our inaugural fund. Although we have received a license to run funds since December 2019. However, we've restricted that to internal capital plus a select number of investors. I don't think they're up to 10. And I try to convince myself and my board as to why we didn't really need external capital in the business. But the truth is, I was nervous about taking external capital. At least with internal capital and very close loop investor base, your failures and successes are not very public. And when things do inevitably go wrong, you can pick up the call to 10 people and apologize. Unfortunately, it hasn't gotten to that. For those who don't know me, I started my career as an emerging market sales and trading expert in London. I spent about a decade at Deutsche Bank. I spent about 2.5, 3 years at Citi, basically doing emerging markets, particularly in this time zone. And there was something quite fundamental that I found out in my 12 years plus of here, is that crisis, economic crisis, so to speak, is a feature and not a bug within emerging market economies. And as painful as crises often are for citizens, they provide really great opportunities for investors. So what you have here are time series chart of total return stock performance of a select number of emerging market economies where I was active during my professional career. And the blue shaded dots here are periods where there was significant exchange rate devaluation, which is obviously an effective barometer for an economic crisis. What you will find is, let's take Russia for example. In 1997, 1998, we had the famous Russian debt crisis. And post that, the Russian markets returned over 900% within the next 5 years in dollar terms and about 18 times in ruble. You can also see other periods of significant currency devaluation. And those have been really good periods of dollar and local currency returns. So what I've done in this chart is to show the same trend across 5 businesses and 5 countries, and for brevity I've tried to keep it short. You will see that from this chart, what you will see is two things. One is when you invest in emerging markets, be prepared for crises. And 2 is for those who can weather those crises, or those who are fortunate enough to invest towards the end of those crises, those present exceptional opportunities to earn positive risk-adjusted return, as you can see from this chart. I don't have a crystal ball with regards to where we are with the Naira. What I would say is that since the attempt at liberalization, the Naira has fallen about 72%, not 300% as is often quoted by the media. And when you compare that to other devaluation cycles, and you look at prior EM devaluation cycles, I think the balance of probability, and I'll talk to why I have a relatively higher degree of confidence that we are probably close to the end of a step change in exchange rate. That doesn't mean you don't have the structural trend around exchange rate. The move we've had over the last 2 years, I would argue that we're getting close to an inflection point. There is another fundamental ingredient that often exists at a time when during an EM crisis, which is a significant de-risking of from investors on the asset class. What you will see here with regards to Nigeria is that there is very limited ownership of equity assets across our collective investment scheme and our pension funds. So we estimate around 12% of pension funds today are invested in equities, and about 3% of CIS are also invested in equities. If you look at foreign participation in the market, as at June 2014, we had about 12 billion of foreign investment. So the stock of free float that was held by foreign investors was about 12 billion. As at the end of June this year, that number is below 2 billion. And what you have on the other side of the chart is the proportion of foreign participation in the free float, in the daily trading activity of the market. At some point, this market was predominantly dominated by foreigners. Foreigners controlled around 70% of the trading volume. Today, foreigners are less than 20% of the trading volume. So you see here that, and also I think a chart that is also not here is retail participation in the market. So when you speak to brokers and from the numbers that we got from CSES, I think there is less than 700,000 active stock accounts currently in the market. Right? That tells you that we have abysmally low level of ownership. And that can function as a way to propel markets when sentiment eventually turns. So the question that we then have to ask ourselves is, would sentiment turn? And could reform be a catalyst for sentiment to turn? I think we will all agree here that although the reforms undertaken so far is needed, the execution, and is well intentioned, the execution and the sequencing of that reform have left a lot to be desired. But even with the less than optimal reform execution, I think it is very difficult to argue against signs of macro normalization. So what do I have here? So there has been what I call a convergence in the short-term interest rate curve, right? And the transmission mechanism between NPR and the short-term rates market has been restored. Similar convergence has also exists in the foreign exchange markets. The parallel market and the official market has also converged as well. Banking sector liquidity is now relatively tight. When you look at the fiscal situation, you can see the improvement on the fiscal side. So this is monthly FAC inflows, and it has gone from 900 billion to over 2.3 billion as of May, and that number continues to grow. External reserves have stabilized, right? There's been some swaps, but there's also been significant growth in IMTOs terminating transactions in Nigeria. which has contributed to that growth. And I think the more fundamental part is we think the fundamental demand for dollars in the economy is declining, right? You see, this is basically our quarterly imports of goods and services. And you can see the trend is lower. Underlying demand for dollar within the economy has improved, right? And because of the improvement in the market structure, the need of capital outflows and local dollarizations have also declined. So while I agree that we need not be where we are and reforms has not been optimal, I think what we have is these sequences of events have contributed to lower foreign exchange volatility. And the latest data is starting to show that inflation is getting anchored. So I also wanted to, this is a quote from the IMF Article 4. So the Article 4, for those who are not experts, is basically a periodic annual review by the IMF. And this is the executive summary from one of the articles. And it says, serious macroeconomic imbalances have emerged in Nigeria over the last year. Inflation has accelerated to, I got that so I don't give away. And instability has prevailed in the foreign exchange market. Although there has been a rebound in economic activity, this is likely to prove temporary in the wake of imbalances. I would like us to guess when that was written, if anyone can.
Someone said 2021. That's not cool.
2021.
Every year.
This is interesting. This article was written in August 2001. 26 months into Obasanjo's administration, which we all widely acknowledge in terms of reform was a successful period as far as economic growth and macroeconomic stability is concerned. The point that I was trying to, as I brought out double digit because I felt like that would give it away. The point I'm trying to make is, even for experts, it is very difficult to have an ex-ante view around the impact of reform in the system. IMF got this fundamentally wrong in 2001. And if you deploy capital into Nigeria, at this point, when the narrative was very negative, you would have probably at least 10x your fund within over the next 5 years. The other point I wanted to make is the last 10 years have been very difficult periods for financial assets in Nigeria. The best performing asset, hands down, has been the US dollar. However, I think local assets hasn't performed as badly as people think. And also, I think the narrative around equity has been so negative. I think the reason why is because people often forget that Nigerian companies are high dividend payer. So they look at the price increase and they forget the cash distribution that comes out of these companies. So what I did in this chart is I went back 10 years, right, and assumed that you invested $10 million, 10 million naira in a select number of equities and equity index, and you have invested $10 million in 1 year treasury bills, and you then, over the next 10 years, reinvested the interest or dividend that comes from this investment over the next 10 years at the prevailing market rate. And you can see that fixed income, which everyone thinks is probably the best performing asset outside of the US dollar, on the short end side has only returned about 29, so 2.9x your capital, so 29 million. And equities hasn't done that bad. So the NGX 30 has returned 30 million. But if you've been very selective around your sector exposure, oil and gas, banking, you can see that despite operating in a macro environment that is really favorable, or you would say is favorable to fixed securities, equities hasn't done badly. For me, what excites me over and above the sort of what looks like a normalization of the macro, which can serve as a very positive catalyst, is what I really see at the micro level, at the company level. This chart here basically has, so in January 2008, the top 5 banks cumulatively had a profit of $1.2 billion. The market value of the top 5 banks was 26.25 billion. So that is roughly 25 times the profit in 2008 that these banks were making. Fast forward to today, in 2023, the top 5 banks made $3.2 billion, but the market value of the top 5 banks is now $6.4 billion. So there has been a 92% derating in the multiples of banking stocks in Nigeria. And there's an argument to be made that 2008 was a bit of an outlier and we'll probably never return there in terms of multiples. What I wanted to say is, even when you go to the more recent trading history, so the post-financial crisis period, devaluation and COVID, and even in the very recent period for the banking sector, I took the average multiples that these banks are trading, and on the bottom chart, if I apply those multiples to the book value and the earnings of the bank, this is what I think they are worth. So GTCO is worth 142 naira from about 45 naira today, Zenith 118 from 36, and UBA 77 from around 20. I think what I wanted to show here is how cheap and how undervalued these banking assets are. And we are now, I think, in a period where the outlook for earnings and net asset growth for these banks is probably clearer than it has been in the last 10 years. The only real uncertainty is on the regulatory side. But I would make the argument that when you have companies at 1.5, 2 times PE, a lot of bad news is priced in. The other sector that we find quite interesting is the consumer sector. There's been a lot of negative press around the earnings of consumer companies recently, and some of them have even reported negative equity. And a lot of popular financial media has basically come up with this narrative that consumer companies are bankrupt. I want to say a few things. Equity for a consumer company, it's not the same as a bank. The fundamental thing as analysts that we need to understand with consumer companies is whether or not these businesses are generating the cash flow to service their obligations. And in most cases for these consumer businesses, the answer is actually yes. What I've done here is to kind of also demonstrate how Nigerian multinational consumer businesses are undervalued relative to their other countries. So, like, let's say we have businesses in Cote d'Ivoire, in Pakistan, and I wanted to demonstrate the undervaluation of Nigeria relative to these other businesses. So the charts that you have here are the contribution of earnings to the group of these multinational companies. You can see for Unilever Nigeria, in 2023, their contribution to the group revenue was $163 million. But yet, the market prices the business at less than 1 time sales. You compare that to Pakistan with less contribution of $124 million, but yet the market prices at 3.5 times sales. what I want to show here is the gap that there's something that my boss used to say when I started in the emerging market, that a dollar end anywhere is a dollar. So for some reason, a dollar in Nigeria is worth a lot less than a dollar in Pakistan, a dollar in Ghana, a dollar in Ivory Coast. I think this is a fundamental undervaluation that would reverse very quickly when macro normalizes. The second part is these businesses are trading at deep discounts to their replacement cost. We've done some analysis here that I don't think is even reflective of the true replacement cost of the business. But what we try to do is basically reflect their capex because a lot of these capex are dollar, right? So the dollar value of those capex since 2019, and then assume that capital spend less depreciation is the assets that these banks are carrying. When you do that analysis, you realize that most of these consumer companies are trading at deep discount to their replacement cost. Everywhere else in the world, branded consumer companies trade at multiples of replacement cost. And the reason is usually twofold. Number one, there is brand equity in these businesses that is not captured in the balance sheets. And number two, these businesses invest in route to market and distributions that are also not captured in the balance sheet, which are very, very valuable. So that Nigerian companies are trading at this multiple, telling you that this is a very, very discount. I think I'll come back to this, but this is basically the turnaround acquisition of Diageo's assets. And I compared that to the price that Diageo sold assets in Cameroon to give you a sense of the delta that exists in value in Nigeria. More revenue in the Nigerian business, about 121 million, and that's 480 million, 3.5 times value. When you use the implied Cameroonian multiple for the Nigerian business, we think that business is worth at least $616 million. The oil and gas sector, for me, is, I think, addressing our medium-term fiscal and balance of payment challenges requires significant investment in onshore and nearshore assets. Incidentally, a lot of these assets are being transferred into indigenous hands. So, Aradel Consortium, I think the Shell assets, Seplat, the ExxonMobil assets, Chapal is getting Total assets, and Owando obviously got the ENI agri assets. Of course, the jury is out if we are going to go the Venezuela route, where transfer of these assets to indigenous player would mean that this production will come out of the ground. But I like Seplat particularly because they have a track record of running marginal fields and great production. They have access to finance via their London listing, and they have a track record of repaying. And what I find really interesting is that the ExxonMobil asset that they are purchasing, we think it's probably worth at least $3 billion. This asset would triple their current production, would double their current reserves, and will give you access to what I think is a transformational gas asset. And we believe that Seplat could actually be a pioneering, one of the largest players in the oil, gas, and power industry. And what I think is even more interesting in this business is the likes of Ajib, of Wando, and Chapal, they need to raise fresh equity for them to be able to consummate those transactions. Two things are happening with this transaction. One, when this transaction was announced, it was supposed to be a $1.2 billion transaction. But there was a lockbox structure that was announced in February 2022, where the excess cash flow was supposed to ratchet down the acquisition price. So we actually think when that deal formally gets announced, that price will be significantly lower than the 1.2 billion headline. The second part that is often not spoken about is settler to consummate this transaction without needing to raise a single dollar from his existing shareholders. And that will make this accretive from day one. This is excluding some really interesting indigenous assets that they have. So for example, they have this annual gas processing business, which we estimate will add another 900 million to the value of the company. So you can see, for a company that is currently valued at the market at 1 point something billion, there is a 300% upside outlook in a name like Settler. Another investment thing for us as Zrosk is, given the economic environment and increased competition from the East, so Turkey, China, India, we think there is going to be, across the continent, we believe there is going to be a replacement of existing industrial capacity in Africa. And Western industrial capacity will be replaced by indigenous and Eastern capacity. We actually see the listed equity space as a theater for that transition. And the Diageo-Tolerant transaction is sort of a harbinger of things to come. For example, Lafarge recently, Holcim, which is the parent company of Lafarge, recently sold its cement business in Kenya, Bamburi, for about, what was the price? For $180 million. This asset has about 3.2 million metric tons of capacity, 158 million of revenue, and about 12% EBITDA margin. Lafarge's Nigerian asset has 10.5 metric tons of capacity, $679 million of revenue, and about a 32% EBITDA margin. The market value of Lafarge today is about $370 million. We think, just inferring from the acquisition, that company probably bought at least 1.5. This makes, and what is really interesting when you compare this to its peers, like Dan said, is that this business has very little debt, less than 2 million. So, and it's trading at 20% of the value of its peers. So you look at this looks like a prime candidate for a transfer from the French owners to either domestic owners or Eastern owners. And this opportunity exists in the marketplace today. At Zrosk, our mandate is quite broad. We invest where we think, we invest across capital structure and across the company's evolution. And we basically go to where we think we can earn the most risk-adjusted return. For over the last 2 years, one of the conversations I've been having with my board, and the theme that we have, is that we think the local equity market provides significant opportunity to compound returns. And at the back end of 2022 and beginning of 2023, we started to significantly increase the internal capital that we manage. That our equity exposure is now 45 times more what it was at the start of that period. And over that period, the small discretionary portfolios and internal capital that I run, within this strategy, has returned 131%, beating the NGX 30 and the NGX All Share by a significant margin. And what the Zrosk Magna Fund is, and what the Zrosk Magna Fund is, it's basically an institutionalized vehicle that allows us to run equity the way we run our internal portfolio. We had to, I think we applied for this fund in May 2023, and because of the way we wanted to run the fund, we had significant roadblocks with our regulator. And there was actually, I went to Abuja 2 times, they came to my office once, to try and explain to them what we are trying to do, and the fact that the typical mutual fund umbrella doesn't allow us to capture the value that we see in the market. And they understood, and this is why I think this is not just your standard mutual fund. For example, the cash allocation of this fund is quite high because we are opportunistic. The bands of asset allocation to stocks and sectors is very broad because we want to be able to take concentrated positions. Across our equity book, I think we probably have 7 to 8 stocks. And even that gives me heart attack. I'd rather concentrate low. So it's high idiosyncratic risk that we are isolating and capturing. And also, we've gone ahead of the future because we think risk management will be core to the success of this fund. And we know that the infrastructure currently exists to use derivative assets for risk management. So this fund is allowed to use derivative assets to manage risk. And as the market continues to evolve, our intent is to be a significant player in that market as well. And the reason behind this is simple. I think when you think about, so because we invest across different products, we are VC investors, we do private credit, right? When you look at VC, VC is basically an extension of the Pareto principle, which is basically the 80-20 rule. And in venture capital, we make an investment in a basket of portfolios, accepting a very uncomfortable level of failure, in the hope that the ones who succeed will give us the return to compensate for the ones who don't, and also allow us to achieve our returns targets. With the listed space, I think it's interesting. Because when a VC company fails, recovery is often zero. These are small companies, light on assets, a lot of their expenses is on payroll. So once the company runs out of cash, there's no asset to recover. On the listed space, however, these are more mature companies with assets. And through fundamental research, you can avoid businesses that the risk of ruin is actually quite low. So the downside in the listed equity space is smaller, much smaller, because your recovery in the event of default is often never zero. But the upside is almost venture scale. So when you look at this risk-return dynamics, you have to ask yourself, how are you allocating capital? So in our internal risk meeting, my view has always been that I see a lot more value in the listed space than I see in venture. Up to the extent that the only venture deals that we've been doing over the last 12 to 24 months are follow-on investments on companies that we've already invested in. This is the opportunity that we see in the market. The Magna fund structure is a standard fund in terms of structure. The assets are obviously held in a trust, and Meristem is the trustee. The custodian is Stanbic IBTC Bank, and the fund is audited by Kirsten Pigar. So it's a standard institutional fund. So in the event that I run away to London for whatever reason, you can go and collect your money from Stanbic IBTC. These are the standard equity terms of the fund. It's an open-ended fund, so there is no upside limit to how much we intend to raise. But for the registration purposes, we are looking to the minimum of 5 million. So 10 million units at 100 naira each. The management fee is 2% per annum, paid quarterly. And then there is the SEC maintenance fees, money for staffing custodian, which are the other professional fees. So total expense ratio is about 2.5%. And there's an incentive fee of 20% of the excess return. And the benchmark for this fund is the NGX 30 with a coefficient of 0.7. And that was a negotiation with SEC, which takes into account what they think the average allocation of assets for the funds will be. I think in the video earlier, we said for all the products that we develop, we are always, and we always intend to be the largest investors. So we will be seeding this fund with 500 million of equity capital. And this is what I think is the average allocation for the fund. The fund is obviously run by what I think is a top-class investment committee, with myself and Rosie with over 25 years experience in investment-related roles. I have Ade Folabi Ogundoyin and Olasowemi, who are independent members of the fund, and they bring very extensive experience in global trading houses such as Goldman Sachs, Jefferies, McKinsey, JP Morgan, and then a representative from the trustees who is the management of the trustees. And this investment team is supported by what I think is a really sound investment team. The investment company is supported by this team. I'd like to gloat a bit that half of the people on this slide graduated as the best performing students in their departments at university. And they have very good, diverse experience from economics, engineering, computer science, and I think we've assembled an investment team that I am very proud of. And I think you will struggle to find a team with the level of intellectual horsepower that this team has. I'll be here for the next hour. So I think at this point I would like to open the floor to questions. Please, any questions you may want or any topic you may require clarity on, I am.
So you showed a slide on the Nigerian banks and how well they've done. How does that compare to me just putting my money in dollars?
Good question. And that's why I had. So in the last 10 years, the dollar has been the standout performer, no doubt. But the argument that I'm making here is that because of the intent of reform, and we could argue that reform is not well sequenced. But there's something I always tell my team with regards to this current government. The current government will do the right thing after they've exhausted all the wrong options. Right? But at least there is that ability to learn and pivot and adjust. And we've seen that numerous times. With the cybersecurity levy, even this windfall tax, there is a reason why the president hasn't signed it. So, yes, there is a learning process. But my argument here is that if you have period of macroeconomic stability, you will beat dollar performance. And I'll give you an example. If you had invested in GT Bank in 2001 when that negative IMF article came out, you would have returned 40% annualized in dollar terms over that period. So we always make this argument that Naira is on a structural decline. And I'll be foolish to argue against that point. But what we often forget that for EM, you have periods of shocks and periods of stability. And periods of stability is when you earn excess return. My argument today, and I don't have a crystal ball, because I have to look at things from a perspective of a balance of probability, is that when I weigh the options in terms of reform trust, in terms of valuation, in terms of positioning, the probability that you are entering into a period of relative stability to give you excess opportunity to earn excess return is much higher than it's been any time in the last 10 years.
I have a follow-up question. So Nigerian banks make stupid amount of money, right? You agree?
Yeah.
Is that normal for any other economy?
So, I think...
No, I mean, because this windfall tax is part of that, right? The government is focusing on that.
Yes,
right?
yes. I want to answer your question. So, I think that people don't understand that I've looked at EM pretty much all my life, and I've looked at EM banks all my life. I think in terms of core profitability of a bank, nothing beats the Nigerian banks. And when you really peel the surface to really understand, and I will differentiate a little bit because they are the really Nigerian banks that are super profitable, because the profit pool in the bank is really driven by five banks, right? So when you separate those banks out, the rest of the banks are not as healthy as the headline numbers suggest. But the point I wanted to make is the core profitability of these banks is very, very high. That is a function of, I think, financial literacy to an extent. So, for example, the cost of liabilities, which is the cost of deposit in GT Bank, as at the last year, is about 1.4%. When you are able to mobilize liability at 1.4% and invest at 28% yields at the moment, you can have insane level of profitability. But having said that, Nigerian banks also carry very high cost structures. Amcon, for example, is 20% of the operating profits of the bank. They pay 50 pips of their assets to Amcon, and we don't know where that money goes. Right? So, while profitability is very high, cost is also very high. But to your question on windfall tax, we'll see what shape that windfall tax takes. I have significant reservation around the thought of the tax authorities to think that they can tax FX translation gains. I do think the tax burden of the banking system will probably go higher. But when something is trading at 2 times earnings, the market is already telling you that it expects that. I don't know if that answers the question.
One last question. Are the FX translation gains going to remain with the new exchange rates?
So, what is FX translation gain? I think we'll probably start there. So, they are basically from largely, I think, 3 sources. There is the translation of foreign subsidiaries in Naira, right? So, like the UBA, ETI, they have big operations outside of the country, and because the Naira is weak, when you translate that asset into Naira, it looks like they made a gain, but in reality, it's not cash, right? And then there is the assets that the banks carry, because something people forget is our banks have quite large level of dollar balance sheets. Between 40 to 50% of banking assets are actually in dollars. So those assets are being revalued, and what that means is that you revalue that asset, and then when you receive the dollar coupons and the repayments on that asset, the Naira value of those repayments is higher. So that is a gain, but that gain only comes when you unwind the books of those banks. And then there's the gain that comes from the trading, FX trading PNL. That is the gain that you, in theory, can tax. The other 2 gains are difficult to tax because they are not realized. Well, realized that. Any other questions?
We keep going, bro.
No, please. I'm here to provide clarity. I think this is something that in investment management, you can never be too sure. And especially when you operate in the market like Nigeria, things do get worse. And when you think that you're at the bottom falls, right? All I can do is make an assessment based on probability. And the thing about probability is you invest based on expected outcomes, but you realize value based on realized outcomes. In the event that these positive scenarios get realized, then I think the return opportunity is very, very significant. I can't even say, so that I don't lose credibility, what I actually think this market can return in a stable macroeconomic environment.
You had mentioned that you are concentrating on about 7 stocks.
Currently, yes.
Currently. So, what's the plan? Are you going to diversify and increase the number of stocks? And if yes, are you also going to put a limit to sector? How much are you going to be investing in the sector? And the reason I ask is that there's a risk when you concentrate on the sector. The potential risk that sector doesn't perform.
Yes.
I don't want you to concentrate on the sector in case anything happens. The banking sector can
Well, I think first thing, that's why I assembled the team that I assembled. Right? This fund is about isolating idiosyncratic risk. It's not about tracking the market. So I accept a high level of tracking error. And and one of the reasons why I've been reluctant to go out to raise money externally is that I also need to get investors that really understand this. It means that on a month-to-month basis you can suffer valuation, but when you smooth that out, you see the thing that we are talking about. So to your point on, am I going to increase the number of stocks in the fund? I think highly unlikely. The reason I say that is there are not many very good companies listed in the market. And I think the really good companies in the market has a structural, strategic, competitive advantage that will probably take some companies decades to evolve. And so I really want to concentrate on names that I am confident around the return on invested capital, I am confident around the growth, I am confident around the quality of the management team. And by doing that, I accept a high degree of tracking error, and I hope my unit holders understand that that is the risk that exists within the fund. Because if I give you a diversified basket of stocks, I will deliver market return. And the promise with this fund is to outperform the market.
I thought the data and I'm curious across the cases where sort of the market sentiment doesn't catch up with the fundamental sort of value of the stock. So is there a risk that that doesn't happen?
No, there's always a risk, right? Nigeria can be Zimbabwe, never converge, right? Nigeria can be Venezuela, never converge, right? I think what gives me a bit of optimism is things are bad in Nigeria, and I don't want to sugarcoat it, right? But there are pathways to resolving our difficulties that are probable, right? So, for example, a fundamental issue we have is that we probably have signs of a fiscal crisis when you look at the scale of debt accumulation, right? What can solve it? If there is the right regulatory framework in place to ensure that these assets that are being transferred to indigenous players are properly optimized, you will see significant growth. But remember, a lot of these assets are also being acquired by leverage. So their banking partners are also monitoring to ensure that these guys can also repay the loans that they provided for this asset acquisition. If we move from 1.4 million barrels a day of production to 2 million barrels on the onshore and nearshore side, where the fiscal terms are very attractive to the country, then you realize that the scale of your fiscal crisis is nowhere as big as you think it is. What you need is intentionality around this, right? And we will be monitoring that, and that gives me confidence, right? That there is an internally generated dollar opportunity that we can mine. The second part is this economy has shrunk in a scale that people have not been able to comprehend. Because I hear people say, oh, dollar demand is inelastic. But the truth is, not a lot of people who send their kids to school are still able to do that. The service side that has been so sticky has started to decline. Because it has been decimated. There's local substitution that is currently ongoing. So, my point is, we have a crisis, but it's not a crisis that is not solvable. And you have a government that has the intent, maybe not the level of competence that will make people in this room happy. But these guys, they dance around, do all the crazy things, and they end up doing the right thing. Right? At least one can say a lot of the initiatives that have been taken on the monetary side has been the right decision. The fiscal side leaves a lot to be desired. I, for example, would have advocated that there's an IMF backstop. But it looks like once you raise that conversation with people that are important, they shut it down. But they will raise their domestic bond, with where the market is pricing spreads for EM currencies, EM debt at the moment, and the outlook for the Fed in terms of rate cuts. If you look at the 1 year forward rates for the US, in 12 months' time, the market is pricing terminal rate at 3.5. That is almost 200 bips of rate cuts over the next 12 months. So you can get a sense that we can, within that context, raise $3 to $4 billion of Eurobonds. So these are the optionalities that exist that makes me assign a higher probability that we will likely be a Turkey or a Russia or an Egypt versus a Zimbabwe or a Venezuela.
So thank you for your presentation, it was really good. What I noticed in the presentation was that a lot of your strategy involves capital appreciation, right? And if you notice, you had said that the US investments in the country was about 12 billion and declined to 2 billion. What that definitely means is that the businesses might actually look at their own value, but a lot of the appreciation has to do with foreign investments or foreign portfolio investments. And as you know, foreign portfolio investments has a lot of dependency on the government policies and regulation, right? Looking at the current trajectory of performance, right, how do you think that the value companies, right, how do you think that it goes down? How's what's really go down?
So what I often say is that the biggest predictor of returns is return, right? I'll use banks because I'm very familiar with the banks. When I look at a GT bank, for example, let's assume this windfall tax doesn't come for the sake of argument. This is a business that I think will probably this year do $1 trillion worth of activity, right? And if you look at outside of last year that there was regulatory pressure, this is a business that pays around 50%, between 40 to 60% of its earnings. The company is currently valued at about 1.3 trillion or so. And if I strip out the non-cash elements of the PBT, it's roughly around 200 billion. So that's about 800 billion. So that's anywhere between 400 to 500 billion of cash distribution that this business has the potential to make. If it does that, then you have a perpetual instrument that is yielding 23-24%. I think even for local investors, especially if we achieve inflation anchoring, disinflation, which I think the probability is increasing, and fixed income yields starts to decline. Equity starts to lose interest, even for local investors. And what I find interesting about foreign investors is they are often late to the party, but they push the market a lot. And what you will find, and what you will always find in emerging markets, is that local investors make a lot of the juice at first, and foreign investors will give you 18 to 24 months for their confidence level to increase before they come. So I'm waiting for them. When they come, I will be the person to provide them with liquidity at a price that I will demand.
Samson, thank you for your presentation.
Sorry, who's speaking?
First question I want to ask you is, how do you compare the present time and the banking consolidation as against what it was in 2005 and 2006? There are concerns from the various sectors that was the consolidation of the addition of prices and where we are, not many people are confident of investing in the financial or capital markets. So it would be nice to know what you and your team think about Nigeria going forward. Then the second thing I want to mention here is I'm personally interested in the amount of key man risk that may exist here. I think you understand what I'm saying there. I think it's a place to look at because it's important. Something happens and something drops there. Sorry for that. This man suddenly is not available. It's important to almost so many Nigerians. It's important to know how this thing functions behind because for someone who wants to make an investment, those things need to be looked at. I think there's a third question I was going to ask before the latter took me off. Okay, so I think that question is, did you say your expected return is 20 plus or so? The fund expected return, did you say 20%?
No, I didn't put an expected return.
Sorry, what did you say?
So we are not 31%.
2.5% total expense and then 20% incentive.
Okay, that was past performance.
No, past performance over since January 2023 was 131%.
Okay, so did you project the future expected performance for the fund?
I haven't done that. And it's
okay, that's fine. That's fine because I mean it's always said that past performance is not a because I wanted to say, how do you even project that? If today, for example, as an investor, I can go into a 10-year bond and I'll get 20%.
Yes.
And I don't have to pay anything.
Yes.
You know, I can decide, okay, you know what? I just have money for 1 year. I want to buy 1 year and I'll get 25% return.
Yes.
So why would I invest in a fund that, you know, but then that's pretty fine.
Yeah.
Please, can you go on and answer my first question?
So first question, banking sector recapitalization. I think that thing has added a few gray hairs to my head this year. Because unlike 2005, for a select number of banks and the ones that we are typically exposed to, we didn't feel that they needed capital just yet, right? But it does appear that there are some individual banks within the system that the authorities have concerns over. And it took a systemic approach, right, to deal with that problem instead of singling out individual names, right? So I think while the 2005 consolidation, you could argue, was needed, although a lot of that capital was wasted, because we have to remember that consolidation gave birth to Ampon, right? So a lot of that asset was fretted away, right? This time around, there are certain banks that require that capital. Paradoxically, those are the banks that are also going to struggle to raise it. The banks that don't require that capital, however, what you have is an injection of capital into this business at a time when the ability to earn decent returns on that capital is actually quite high, right? So that's one. Two is, with the nature of how this capital raise has gone, I mean, that would be very disappointing to me because I thought the capital raise was going to be successful and there's going to be a lot of foreign participation. It does appear that while this capital raise for some banks will be successful, it's going to be largely done by insiders. And if that happens, what will likely happen is that the effective free floats in these banks don't actually go up because they're going to be tightly held. So the effective free float doesn't go up, but the capital equity base of this company goes up at a period where interest rates are extremely elevated, so the ability to earn decent return on that capital is quite high, right? So if you do your fundamental work, which Zrosk could try to do, we can identify the banks with significantly less asset quality concerns where the capital is going to go in and get wiped out. right? And those banks are going to contribute to the bottom line and increase, I think, the earnings and dividend outlook for these companies. The only caveat I have is the regulatory risk, and with that, it's not even the CBN. I'm worried on the fiscal tax side, right? And until we get some clarity around that, it's very difficult to make an assessment. But the way I see it is, market is all about expectations. Expectations for the Nigerian banks are at rock bottom. So you will actually might see a scenario whereby once we get the clarity on this fiscal side, these banks actually just start to run. And it happens because a lot of people who are currently investing in banks are people with high degree of conviction. All the speculative money that was supposed to come into this recapitalization, they've all run away. So if I have high degree of conviction and I invest in the banks, and then when the dividends start to come and the earnings start to come and you want to come and buy from me, I will tell you my price. And second question on key man risk. I have taken the time to build a young, highly intellectual team. I wouldn't lie that at the moment I drive the vision and I drive the investment decision making within my team, but I have gone from doing a lot of the analytical work on myself to relying on the team that does a lot of that work for me. And what I am building within my team are people that over time can make the sort of investment decisions that I make. And we will go through the process of institutionalization. And what we have as Zrosk is not particularly unique. You look at a lot of global asset managers, one person drives the vision. Berkshire Hathaway, up until recently, was driven by Warren Buffett. Over time, he institutionalized. We are at the start of that journey, and the reason I have spent time to painstakingly build the team that I have built is because I want the business to have a lot of institutional members.
Thank you. I think we can only take one or two more questions.
Thank you very much. You have given this amazing presentation. However, I have three questions that are quite in the moment, so you will basically be able to answer them together. So basically, the first one is, how do you anticipate adjusting the portfolio in response to changing market dynamics? Because basically, we've seen the transformation of the markets that have been profitable over the past 15 to 20 years in this country. And how do you manage conflicts of interest within this forum? And my last question is, what's your approach to liquidity management, especially in volatile markets?
The question of conflict of interest, we are large investors in this fund, and I think we'll continue to be large investors in this fund. Most of the returns that I intend to make from this fund is from the performance of the fund. I have a private portfolio that I manage for a select number of investors. Some of them are going to roll into this fund, others may choose not to for their own reasons because there are constraints around redemptions, etc. in this fund. But what I have, as far as equities is concerned, is a uniform strategy across my private portfolio and the fund, right? And you could, and I also make the point is also like I am running my private portfolio based on investment policy statements that are devised with those clients, right? So there, I can't say that conflict doesn't exist, but I think the conflict that exists with my business is the same sort of conflict that you find in any standard asset manager. So what was the other question? So approach to liquidity management. The stock market is not very liquid, and we pay concentrated bets. So there is a level of, and the reason why I size my position the way they do is that I try and stay on the liquid end of the market, right? So I'm in relatively large companies, and where I go into smaller cap businesses, I size my position for that, because when I go into smaller cap businesses, which is often rare, is the outlook I see for the return more than would affect how I size that position. But liquidity is something that is a concern. So sizing, holding, so one of the, if you read the four perspectives, one of the things you find is that my cash allocation is quite high. So I need to be able to hold a sizable amount of cash to be able to deal with redemption. And then as the market evolves, I think the futures market would allow me to really, really manage liquidity better. And that's how I see liquidity management. There's one more question you asked.
Yeah, how do you anticipate adjusting the portfolio to change the market dynamics?
That's our job, right? So if I tell you that's a great thing. But what we try to do is we work quite invest in compounders. So typically, and I think I have one or two of my brokers here, they tell you that they never really see a sell ticket. And that's largely because I have very high conviction on the things that I invest in, and I run it for a few years. And then when that opportunity disappears, I rotate out of that into the next fund. Right. So the fund is flexible, so I'm not static with my asset allocation. I can switch. I can also take into account macro drivers to decide how much cash allocations I have. So if we've gone through a period of long level of stability in the macro, and for some reason there's a recession, deep recession in the US, and I have an outlook that oil price is going to collapse, that would affect my asset allocation very quickly, and I can start to think about how much cash I can raise from the existing portfolio to allow us to take advantage of drawdowns.
I think this is the last question. Oh, sorry, this is the follow-up.
Alright, okay. So as regards risk management, talk about the use of derivatives for risk management. Yeah. Now, since it's a SEC licensed fund,
Yeah.
are you allowed to, I don't know specifics anyway, but are you allowed to go into bilateral contracts with banks for derivatives, or must it be FMDQs?
Exchange traded. So the current license I have has to be exchange traded. I can't do bilateral yet.
Okay.
It was a long negotiation point with SEC. I wanted to be able to do bilateral, but they said they needed a bit more transparency and when they get confidence around how I manage the fund,
Last one. How much have I missed it? So, since the number fund is specialized,
Yeah.
are you allowed to put a part of your VC book onto the fund, or is just strictly stock exchange?
So two things. I would have loved to, but however, it's an open-ended fund, and I think it's too risky running a VC strategy with an open-ended context. What I intend to do is to raise a closed-ended fund to invest specifically into venture type opportunities. So this is really for listed opportunities, but the point that I'm making is that actually you don't need to take VC risks to make VC return if you invest in this fund.
I don't know what I missed it, but imagine we all invest. The question is, you have a 20% tax for initially
The NGX 30. Yeah. So with the coefficient of 0.7. So basically, if the fund returns 50% and the market returns 20%, I basically charge 20% on 30% or 4% or whatever that is.
I think those are all the questions. Do we have any other? I think that's the end. Thank you very much.
So there are no charges as long as the fund makes less than the NGX 30.
Yes. So there are two things. So there's a high water mark.
2%.
There's a high water mark, right? What does that mean? Is that it means that if the fund returns a positive number today and it returns a negative number the following year, I can't charge incentive fee until I meet the previous high, right? So that kind of means that I'm not charging you twice on the incentive portion. And so that's one. And then the two is if I underperform the market, I can't charge incentive.
Thank you very much. Thank you, Samson. So next we have Shola Dini, who is the CEO of Zrosk Magna. That's where everything all started. So began the business, fixed income trading after living in London, invited Samson to Nigeria, built his business, and he's here to give you guys.
This is a bit uncomfortable standing before you. And I'm so happy everyone is there because we want to experience a bit of my day, which is you start at that, I don't know, 8 o'clock and you argue this argument, go on this kind of speech with Samson, gives you all this analysis. You don't have 2 coffees, you're in trouble. So, yeah, thank you for coming, thank you for listening. I'll make the first thing, which is that this presentation I'll make available because I'm sure a lot of people like me. You need to go and read our CFA again. He said a lot there. I know one thing is, Samson is not a speculator like most of us. We know ourselves. We don't want to really do all this hard work. Samson is happy to do that, and for me, a big burden off my shoulders. So first, let me say thank you to everyone for coming, and then I'll just read my little speech because I think it's easier for me. So this journey of ours, what we consider short by the oldies in this room, is a process we have ensured has only been brought to our target clients after it's been well tested against our own rigorous in-house metrics. Metrics I would consider more stringent than those on the street. I'm very afraid to take people's money, and even worse, losing it. Zrosk Magna is well proven and tested final version of this very rigorous process. It's rooted in fundamentals of the market, but with a very clear acknowledgement of volatility, liquidity, and an important need for prudence in investment calls. Rigorous market researches have been done, and it benefits very much from a very flexible investment approach, ensuring we constantly stay ahead of the curve. I have very massive faith in Samson. He has prudently built Zrosk Investment from the ground up. I consider him a very value-driven investment manager. Unlike me and many in this room, we are speculators. And to be honest, we all know ourselves. We don't want to read, we don't want to do Excel, and I can tell you 100%, we don't want to read the fine print. He is the opposite of us, ladies and gentlemen. He is very fact-driven, numbers crunching, and crucially not very emotional in his decision. He has made us some very attractive returns on capital, and it's a shame that now I have to share him with the world. As an engineer by training, I will illustrate my last point with Newton's first law of motion. It says that a body at rest remains at rest. A body in uniform motion continues on that constant velocity, and it will remain on that motion except an external force acts on it. What am I trying to say? Zrosk Magna is the external fund, ladies and gentlemen. What it's looking to do is give momentum to your money at rest in your current bank account, mostly in your current account that is earning 0. It will also give external force to your monies that are in this steady motion of fixed deposit, that you can take it from where it is to a higher trajectory of true return on capital. Ladies and gentlemen, give your money some momentum today with Zrosk Magna Fund. We have the vehicle to take your money to greater places. Thank you very much.
Thank you, Shora. Thank you, Samson. So, this is the final stage. So, this is why we are here. So, there are QR codes on the table outside. Each table has a QR code, you can scan it. The minimum investment is 5 million naira. You can invest as much as you want, 5 million, 1 million, 5 million. It's all good. If you want to get more information, send an email to samson.esemuede@zrosk.com or info@zrosk.com. Reach out to anyone who has tag here. You can reach out to anyone here. I think that's it. Thanks for coming, and we hope you